April 2026. The headlines say the U.S. economy is growing at 3.3%. They say unemployment is stable. But if you look at your bank account, or the price of a steak, or the 10-year Treasury yield, something feels wrong. The old rules of money died in late 2025. We've entered the era of the ghost economy, where AI-driven productivity is masking a massive shift in how value is actually created. Today, we're pulling back the curtain on the 2026 trends the mainstream media is too scared to explain. If you own a single share of stock or a digital wallet, you need to see this. First, the Fed's nightmare has arrived: stagflation. In early 2026, we've hit a paradox. High tariffs and rising energy costs from the Iran conflict are pushing prices up, but the job market is cooling. Usually, the Fed raises rates to kill inflation, but doing that now would trigger a labor collapse. Look at the data. The Genius Act passed last July, finally regulating stablecoins like real banks. It was supposed to bring stability. Instead, it's triggered a massive capital flight from traditional savings accounts into regulated digital dollars. The banks are sweating, and for the first time in 50 years, the US dollar is fighting a war on two fronts: geopolitics and code. Why hasn't the market crashed yet? One word: AI productivity. In 2026, companies aren't just using AI, they are being rebuilt by it. We're seeing record business investment in data centers, not factories. This artificial growth is keeping the S&P 500 afloat, but it's a lopsided victory. While tech giants are printing money, the average Joe is facing a zero-growth labor market. Immigration is down, hiring is low, and the low-hire, low-fire cycle means if you have a job, you're stuck. If you don't, the machines have already filled the gap. We are witnessing the decoupling of corporate profit from human labor. So, where is the smart money going in Q2 of 2026? It's not where you think. The 2022 playbook, buying energy, is getting risky. Analysts at JP Morgan are now pointing toward a quiet defense. We're talking utilities and healthcare. In a world of volatile oil and AI bubbles, people still need electricity and medicine. These sectors are currently undervalued compared to the tech-heavy NASDAQ. While the crowd chases the next AI token, the whales are quietly moving into boring assets that pay dividends in a high-interest world. 2026 isn't a year for passive investing. It's a year for survivors. The gap between the digital economy and the real world has never been wider. The question is, which side of that gap are you on? If you want the deep dive breakdown of the new Genius Act regulations, hit that subscribe button. We're tracking the ghost economy so you don't get haunted by it. I'm your channel name, and this is Mint and Macro. See you in the next one.